I have at least 10 ways to skin a cat. Skinning a cat means various ways of coming to the valuation of a company. Number one, it's the sum of all predicted cash flows. This is the only correct way to value a stream of cash flows, as my tutor used to say. The problem with it is that even though it's the only correct way to skin a cat, it's very difficult, very messy, it takes a long time, and it involves a lot of unpredictable variables that it makes it complete guesswork. And the only thing you can be sure is that you have calculated something using the exact right formula, but you have come to the exact wrong conclusion and value. Number two is a multiple of a proven earnings capacity, a proven earnings capability, also called price earnings. Number three is made of other accounting multiples, such as price sales, EV to sales, EV/EBIT, EV/EBITDA, EV/EBITA, price book, return on equity. You can use any kind of multiple you want. We'll just say that if the second way to skin a cat is price earnings, then you have a lot of similar ways to skin a cat through other multiples. Number four is based on the company's dividend history and likely future dividends, perhaps based on company guidance for how much they are going to distribute in dividends. So it's dividends for number four. Number five is comparing the company to similar companies and saying that it should have a multiple, a valuation multiple that is similar to similar different companies. So we simply just move the burden of proof, the burden of evidence to other companies, saying that we depend on other investors to say that this is how the industry should be valued, and consequently our company should be valued in the same way. So that's a fifth way to skin this cat. Number six is similar to number five. It's just that this time we compare the company to the average market and say that the company should be valued using the same principles as the market. So perhaps adjusted a bit for the differences between the company and the market, but in general, the principle is simply to compare it to the market and make sure that whatever differences there are, they should be the same now as they have been historically between the company and the market. Number seven is using interest-like gauges. So now we stop looking at multiples or things like that. Instead, we look at the earnings yield or the dividend yield or cash flow yield or return on equity compared to the price-book ratio. So what we're trying to calculate is what type of interest rate are we getting on our invested money. If we invest 100 and we get 7 back each year, that is like a 7% interest rate in a way. And you can compare it to a bond investment or anything like it. But there's a difference of comparing these interest-like yields than comparing multiples or a sum of cash flows. So that's the seventh proper way to skin a cat. Number 8 is just looking absolute bird's eye perspective on total available market. If a company has a certain total available market, that gives you a ceiling of how much the company can actually be worth if they were to take 100% of the total market. And on the way there, you can say that if this is the total available market and they get a 20% market share, and you see what other companies are valued, they will all together share of this total pie. And what you're basing it on is not valuation multiples or anything like that. You only base it on what the total annual sales potential is for this category. Number 9 is looking at total market capitalization. And it could be total share of the total market capitalization. For example, right now, the Magnificent Seven, the big tech stocks, they have something on the order of 40% of the market cap of Standard & Poor's 500. Historically, the largest 5 or 10 companies typically are at about maybe 15% of total market capitalization. So how far can that go? What is reasonable? I don't have a fixed rule of thumb for this, but at least it's a way to triangulate the boundary conditions for how much a company could be valued, or a group of companies. So total market capitalization and total market cap compared to the entire index market capitalization, or the entire economy, like the GDP measure. And finally, maybe the messiest of messy and simplest way of all to skin a cat. Just rip it off. Look at the share prices themselves. You are completely value agnostic. You don't give a single F on what the profits are, what the dividends are, what the growth rates are, comparable companies, history, the market, whatever Trump or Musk are saying. The only thing you look at is, what is the share price trend, the share price pattern? Is it moving up? Has it moved down a lot recently, or has it been moving up for a long period of time? Does it produce the formation of a vomiting camel? Whatever that means for future stock prices. But you simply look at the patterns. You are completely value agnostic. You are a technical analyst at the core. And the only thing you care about is, will this pattern repeat, and in what way? And you use that as a basis for if it's a better or worse than average time to invest in the stock right here, right now. So we have 9 valuation-based variants, and number 10 is the one that almost everybody solely depends on, and it's just looking at the share price and the share price trends. I think you should use the first 9 as your beacon of investment, and the 10th to adjust slightly your timing and your entry and exit points for an investment in a stock.